The defining battle in AI semiconductors. The competition between AMD and NVDA represents the most significant structural conflict in high-performance computing today. As we stand in October 2025, these two semiconductor titans are both primary beneficiaries of the massive AI boom, yet they present investors with two fundamentally different investment theses. This isn't just a story about two chip companies, it's about the future of artificial intelligence infrastructure and where the incredible value creation will flow in the coming years. Executive summary: the AI titans' bifurcated investment case. Let me frame this clearly from the outset. NVIDIA is the established champion, the quality premium play offering unparalleled financial stability and pure exposure to the AI megatrend. Their investment case rests on what we might call impregnable moats, the CUDA software ecosystem that has become the industry standard and operational execution that delivers industry-leading gross margins. This is the safe harbor in the AI storm. AMD, on the other hand, represents the growth arbitrage opportunity. This is the challenger thesis, the belief that the market is significantly undervaluing AMD's potential for massive earnings acceleration as they execute their MI350 and MI400 accelerator roadmap and secure major hyperscaler wins. While riskier, AMD offers what we call asymmetric return potential, the chance for outsized gains if they successfully penetrate NVIDIA's dominance. Scale and market position, the David and Goliath dynamic. The scale difference between these companies is almost difficult to comprehend. NVIDIA has reached a staggering $4.55 trillion market capitalization. That's 14 times larger than AMD's $330 billion valuation. In data center revenue, the gap is even more pronounced. NVIDIA is projecting $177 billion in FY 2025 data center revenue compared to AMD's $7 billion, a 25-fold difference. But perhaps the most telling metric is gross margin. NVIDIA maintains a remarkable 72.7% non-GAAP gross margin, while AMD struggles at around 54% even after adjusting for one-time charges. This 18 percentage point gap is the clearest financial evidence of NVIDIA's pricing power and ecosystem advantage. However, AMD's smaller base means they have much more room for growth from even modest market share gains. Financial performance deep dive. The numbers from the most recent quarters tell a compelling story. NVIDIA delivered $46.7 billion in revenue last quarter, growing at an incredible 56% year over year. Their data center segment alone generated $41 billion. This is scale that's unprecedented in semiconductor history. AMD, while much smaller, is still posting impressive growth, $7.7 billion in quarterly revenue, representing 32% year-over-year growth. But there's an important caveat here. AMD took an $800 million inventory charge related to export controls, highlighting the geopolitical risks both companies face. Where NVIDIA truly separates itself is in capital allocation. They returned $24.3 billion to shareholders in just the first half of fiscal 2026 and authorized another $60 billion in buybacks. This is the financial profile of a mature, incredibly profitable company. AMD, by contrast, is reinvesting everything into growth. They're playing catch-up, and they need to. Valuation analysis, growth-adjusted metrics tell the story. Now, this is where the investment case gets really interesting. If you look at traditional valuation metrics, AMD appears expensive with a trailing PE of around 117, while NVIDIA looks more reasonable at 53. But these numbers are misleading because they look backward rather than forward. When we examine forward-looking metrics, the picture changes dramatically. AMD trades at about 25.6 times forward earnings, while NVIDIA commands 34. Even more telling is the price-to-sales ratio, AMD at 11.23 versus NVIDIA at 28. But the most important metric here is the PEG ratio, the price-to-earnings growth ratio. AMD's PEG sits between 1.07 and 1.12, while NVIDIA's ranges from 1.28 to 1.36. This difference is significant. It suggests that investors are getting substantially more expected earnings growth per dollar invested in AMD. This is the core of the growth arbitrage thesis. Competitive moats and ecosystem warfare. The fundamental battle here isn't really about hardware, it's about software ecosystems. NVIDIA's CUDA platform represents one of the most powerful moats in technology history, with 94% market share in discrete GPUs and an ecosystem that has 10 times the activity of AMD's ROCm platform. The switching costs for customers are enormous. CUDA functions as what we call an ecosystem inertia tax. Customers stay because leaving is too expensive and difficult. AMD's ROCm strategy takes a different approach. It's open source, offering more flexibility and potentially lower costs. They've secured crucial strategic wins with Microsoft, Meta, and Oracle. But here's the critical challenge. These initial wins are often motivated by hyperscalers wanting supply chain diversification and negotiation leverage from NVIDIA. The real test for AMD is whether they can convert these strategic placements into sustained volume and, most importantly, drive third-party developer adoption beyond their major cloud partners. Growth catalysts and roadmaps. Both companies have aggressive innovation roadmaps. AMD's MI350 AI GPUs promise a 35 times leap in inference performance, with the MI400 series coming in 2026 for another massive jump. They're also pivoting towards integrated rack-scale solutions. NVIDIA isn't standing still. Their Blackwell Ultra platform is ramping production, delivering what they call exceptional generational leaps in performance. They're focusing on systems-level advantages through NVLink rack-scale computing. The market opportunity is almost unimaginably large. The AI GPU market is projected to reach $400 billion by 2030. If AMD captures just 10% of this market, some analysts project the stock could reach $427 per share. We've already seen how sensitive AMD's valuation is to competitive news. Their shares surged 24% on the OpenAI partnership announcement, while NVIDIA declined 1%. Risk analysis and headwinds. Both companies face significant headwinds. Geopolitical risks are very real. Both have been impacted by US-China export controls, with AMD taking that $800 million charge and NVIDIA facing restrictions on H20 sales. The competitive landscape is also evolving dangerously. Hyperscalers like Meta are developing their own AI chips, creating long-term pricing pressure and potential market share erosion. Both AMD and NVIDIA need to pivot towards higher-value integrated systems and software solutions to counter this threat. For AMD specifically, the execution risk around their ROCm software adoption timeline and MI350 and MI400 roadmap is substantial. For NVIDIA, the primary risk is valuation compression. The stock is priced for perfection, and any stumble could be punishing. Investment recommendation. After analyzing all the evidence, here's our conclusion. For growth-oriented investors with a 3 to 5 year horizon and tolerance for volatility, AMD presents the superior opportunity. The PEG ratio differential of 1.07 versus 1.28 to 1.36 creates a compelling growth arbitrage. If AMD executes successfully, we could see both earnings acceleration and multiple expansion, the famous double play that drives exceptional returns. However, for core portfolio allocation seeking stability and proven execution, NVIDIA remains the essential AI cornerstone. Their scale, profitability, and shareholder returns make them a foundational holding. In practice, we recommend a bifurcated approach. Growth portfolios should weight more heavily towards AMD to capture the asymmetric return potential, while core portfolios should maintain NVIDIA as the primary AI exposure with a smaller AMD position for upside participation. The bottom line is this: the AI revolution is creating one of the largest wealth creation opportunities in market history. Both AMD and NVIDIA will benefit, but for investors seeking maximum growth potential, AMD's valuation story and market position